Now, this question is actually both for Phil and Eduardo. Tell us a bit about your background and your personal history.
Phil, you want to go first?
I'll let you go first.
Well, I'm older, so it's going to be longer. That's why I was saying.
Okay, I'll go. Yeah. So my name's Phil McInnis. I joined Avantis Investors back in June of 2019 as we were getting things started. Prior to that, I served as head of portfolio solutions at Dimensional Fund Advisors. Had a long career there that I really enjoyed. And prior to that, I got my introduction to capital markets really as an institutional investment consultant at now Willis Towers Watson. Used to be Watson Wyatt when I joined. And I've around, call it 15 years or so in the investment industry. Grew up in the Northeast of the U.S., so not quite as far north as you, Mike, and you, John, but I am familiar with the colder weather. So grew up in New Hampshire. Ended up moving south to go to Emory University for undergraduate, and got used to the weather, and met a girl from Texas, and she said, if this ever goes anywhere, we're going to be living in Texas. And when you meet a pretty girl and they say something like that, you just say sure, and then she held me to it. So ended up moving to Texas back about 10 years ago, and so reside in Austin here.
And he's moving to Los Angeles next year, I think, but he doesn't know yet. So I'm Eduardo. I was born in Argentina, so that's why I have an accent. Everyone has an accent, no matter where you are, depending who it's a measure of who measures the accent. So I have an accent. I'm from the South, as you see, very, very deep in the South America. And I came to United States to do grad school. So first I was at Brown University. I got a master in mechanical engineering. My undergrad is in civil engineering, so then I got a master in mechanical engineering from Brown, and then I got a Ph.D. in aeronautical engineering from Caltech. So at that point, I just couldn't find more engineering to study more, so I decided to work in finance, and here we are. I started working in finance in 2000. I show a photograph when I got married, so this is more or less when I started working in finance. There you have, that's me. So a long time back, and then you have the 2000 crisis, the 2008 crisis, the coronavirus, and now I have a little bit more white hair because of all that. And I work in Dimensional Fund Advisors. I was a CIO and co-CEO there for a long time. It was a very nice place to work, but at some point, family wanted to live in Los Angeles. See the background, that's Los Angeles. I'm in downtown LA now. And so I resigned from Dimensional, I came back to LA. And around 2 years ago, started speaking with people from American Century. That's a big company based in Kansas City with offices in New York, San Francisco, LA, and outside the United States, London, Berlin, Hong Kong, and Sydney. And to start a new brand inside American Century that invests money in a different way. And here we are. We created Avantis Investors. And we have been here for 18 months with products in the market. And it has been quite a lot of fun.
Go ahead, Mike.
No, John, go, please.
Yeah, I'm relatively new. I've sort of been in the DFA mode. Perhaps that's probably where I met Mike at one point, because they often had seminars in Toronto for financial advisors. I'm not an advisor, I'm more of a journalist. But ironically, right now I'm doing an annual ETF report for Money Sense magazine that I used to be the editor of. And we have this category of funds called desert island picks, like Motley Fool, where you could pick one fund that you'd be comfortable holding for 5 years if you were on a desert island, and you could recommend it to your family, your friends. And the two people from PWL Capital, I don't know if you know them, Ben Felix, you probably know Ben, and his partner Cameron Passmore, both picked, and I'm hoping this is the right company, the right funds. The Avantis is an international developed small cap value stock, AVDV sticker, and the other one was the international developed all cap value, AVUV. Right funds, right company, and right first of all?
Well, the company, I cannot mention funds because then compliance will shut this interview, so I will not tell you any ticker, and I will not acknowledge any ticker. But Avantis is a company. We're Avantis investors. We manage money. We have ETFs in the market. We are very, very proud of our ETF there, and we're proud how we manage money. And I know the guys at PWL for a long, long time from my previous life, and they're great people.
So that I've identified the right company. I just wanted to make sure there wasn't some other Avantis. So that's the same company. I find, like I said, Mike, the people who, the investors who kind of pick, the financial advisors tend to go with Vanguard, DFA, and it sounds like you guys, Avantis, are sort of built in the same mode. And in fact, I don't know whether people are shifting from one to the other, or they're doing you as well as these other kind of companies. I mean,
look, you have a little bit of everything. You have people that are using us together with Vanguard and DFA and iShares and who not. So it's people want name diversification many times, and it's a good idea to have name diversification because you are diversifying across securities, you are diversifying across sectors. Well, why not diversify across managers? So many people use us in that way. Some money shifted, for sure. Money shifted to us because 18 months ago we didn't exist, and now we have more than 4 billion under management. So money shifted, and it hopefully will continue to shift. We see good cash flows and good adoption, and so partly because I think we provide good investment solutions at good price, in good packaging because we do ETF, also we do mutual funds and SMAs. And so I think we provide very good toolkit for advisors to help their clients. Our goal is to help an advisor help their client. And so we provide this toolkit. So, and it's expanding. We're going to have more. We already have 8 ETF in the markets and 8 mutual funds, but we're going to have more by the end of the year. And because we really focus on how can we help an advisor or a consultant help their clients. And if we provide the right packages of investments with the right wrapper, ETF, mutual fund, SMA, whatever it is, the advisor then can decide what's the best combination to get their clients to the right position, down the road in retirement or whatever goals they have. And that's our goal. We take it seriously.
Phil, maybe you could just jump in for people who are not aware of the Avantis approach. Just give us a broad overview of how your philosophy and how you structure things.
Yeah, absolutely. I would say at a 30,000-foot view, kind of what we're looking to do. It's the idea that there's information that is in market prices, right? And so our goal, our approach is more to figure out how do we use the information that's in those prices. If I'm going to observe where a stock is trading at in Bloomberg today, take that price and understand, combining that with other company financial information, which companies have higher discount rates or higher expected return. So we have a really systematic way of how we're going to approach that and do that. And the goal really is this idea that, if you think about the market portfolio, which is a good portfolio, right? You can buy that in a very low cost way from an index fund. There's a lot of reasons to like it. We think that you can have strategies that have a lot of the same characteristics of something like a broad-based index there. So it's going to have low fees, it's going to have broad diversification, it's going to have low turnover and be tax efficient. But we think you can do a little bit better, right? And so that gets back to, I think, a lot of our roots, which are more in the financial science side of things. All the research that's come up over the last 50, 60 years in terms of asset pricing and what we've learned about how investors price securities, what characteristics they look for, what types of information can be used to discern which companies have higher discount rates today. So what's an example of that? If you think about, the Fama French 3-factor model was quite famous. It was sort of state of the art in the early 90s there. It's created, I think, a lot of adoption around that sort of model. It found that a single factor model, right, just CAPM, wasn't explaining all the returns. There were other factors, right, high minus low in terms of book to market, or small minus big in terms of company size. So we're trying to take the learnings, that knowledge from asset pricing, but really try to bring it back to fundamentals, right? And so when I say that, when I'm talking about bringing it back to fundamentals, there's this whole host of literature. There's more than 400 factors that have been documented in the academic literature. There's products that are mixing a lot of very different things. We're trying to really come back to fundamentals and think about an elegant way to build a strategy. So the idea that if I'm looking at a company, if we're going to go buy a company together, we need to take a look at the balance sheet and understand the balance sheet. We also need to take a look at the income statement of cash flows and understand the health of the business from that perspective. You need both together. And Eduardo, when he and I were talking about these types of solutions, how to design them if you're really starting from scratch with all the knowledge that we have today, he had a really elegant way of how he thought about putting these together. So that gets back to the goal of, we don't want to, there's a lot of sort of uncertainty, right? Investing in equities and investing in the market. So we don't want to add to that uncertainty unnecessarily. We're trying to really understand how can we embrace that part of the uncertainty and deliver a strategy that's broadly diversified, low cost, tax efficient, but has the ability to do a little bit better.
Now, most of the large investment firms have 500 or 600 analysts located all over the world. How is it possible that all of these highly educated, hardworking professionals can't seem to outperform a broadly diversified, low-cost, evidence-based approach over any long period of time?
Well, some of them may be able to. Let me be clear. Some of them, but who knows who they are, and probably they don't even know who they are. They cannot be the ones that they know that they're going to outperform until after the fact. So, you have a lot of people there. No, but look, imagine that you want to do something by hand, yeah? But there exists a machine that can do it for you. You're putting all this work, and it's very, very expensive to do, when a machine can do it much faster. Imagine that you want to do everything that Excel does for you by hand. My goodness, you can spend hours doing pluses and minus and multiplications and plotting things by hand. Is that the most efficient way to do it? No, because you can do with Excel much, much faster. So this is basically the same. If I find 500 analysts, they will do a lot of work. But by using science, you can do all that work much faster, integrating all the data feeds and analyzing all the data in a way that is more and more efficient. So what's the benefit of doing that through science and data management and efficiency? The benefit is, first, less costs, because I don't have to pay for 500 analysts that don't add any value. I'm just paying with a piece of software and data that is less costly and more accurate. Yeah. What else do I do? Well, I can analyze more companies, because 500 analysts, how many companies 500 analysts can analyze in a month? 20 each? I don't know, pick a number. So it's a limited amount of companies. When you have data feeds that are good quality and you manage the data properly and you have the systems and the science behind, the computer power is the limit at that point. So our approach is try to systematize as much as possible every piece of asset management that you can to be efficient and reduce costs and increase reliability. And imagine making a car by hand. Every screw by hand. You are going to spend years to make one car. Henry Ford solved that issue with all the line production. And so systematizing processes helps because you increase reliability, you increase the output, and you can analyze more things. And at the end of the day, you're using the latest technology. And that's what we are about. We are about using the latest technology in financial science, in operational research, in structures. That's why we have ETF from day one and mutual funds. So we have all these in order to help advisors.
Now, you spoke a little bit about patience and discipline. Now, how important is patience and discipline in terms of having a successful investment experience?
Man, it's absolutely important. Look, no one is patient. Look, you want to get your goal. You want your goal today. Imagine that you want to lose weight. I want to lose weight by tomorrow, but it's not something that you will do by tomorrow. It's a process. It's a long-term process. And the process is full of noise because tomorrow is your wedding anniversary. So you have to take your wife out for a nice dinner. And, there you have. Tomorrow is not going to be a good day to do diet because you're going to a nice dinner. Well, the market is the same. We are focused on the long-term process of achieving our financial goals. But the market is going up and down like that every day. And we need to be patient with all these up and downs and always focus on the long-term goal. And, it's difficult. It is difficult. It's difficult if you don't have an advisor and you don't know enough about finance because, the daily noise, the news that we get, everything is horrible, everything is great, coronavirus, I don't know what else, everything is trying to distract us from the long-term goal. And all of us suffer a little bit with that distraction because, we are putting all our savings there. So it's very, very personal. It was difficult to get all that money, save all that money, and we are putting it at risk, and we see all these movements in the market. So patience is fundamental, and advisors help people have discipline because advisors are professionals and they know the business. So they keep the investor focused on the long-term goal and to forget about the daily noise. So, it's fundamental patience and it's fundamental having good advice.
You've raised a question for me here. I mentioned a couple of funds that we aim at the package at do-it-yourself investors who can buy ETFs by themselves without an advisor if necessary at a discount brokerage, on an online brokerage. If I recall, at DFA, you could not buy DFA funds that way. You had to go through a fee-only advisor. Mike could probably correct me here. Is that the same model for Avantis and New Century?
American Century. No, Avantis, in an ETF, we have ETF in the market and mutual funds. The mutual funds, it's not, most of the times you have to buy with the financial advisor because of where you can purchase. You purchase them in institutional platforms, or unless if you are an institutional investor, you can do it directly. Yeah, but ETF is a public security. ETF trades in the market. Anyone can buy an ETF. You can buy 3 shares, 1 share of an ETF. So anyone can buy an ETF. Now, we don't do advertising, so we are not targeting retail investors. We don't have a 1-800 number, please retail investors call us, because we are not the right people to provide advice to retail investors. Now, people like you that put model portfolios and give advice through electronic means or online, or just other people that do it in person, all that are putting context of how to create a portfolio, how to think about asset allocation, and how to deal with uncertainty and market fluctuations. So you guys are helping people just have a good investment good investment portfolio to achieve their goal. And so we don't do that, and we don't advertise in the retail marketplace. So if people find that, it's because people really know about investments and they have read enough to the point that say, "Ooh, I'm looking for this guy's called Avantis," because it's not that they see in the a big advertising on TV or anything. So yeah, we're always focused on trying to provide good investment solutions for people, and we know that others help with that goal.
You'd mentioned the current environment, the investing environment. I'm curious how, right now there's a lot of talk, as you know, about interest rates going up and the inflation coming, and the going from the stay-at-home stocks, the COVID-resistant stocks, to the the cyclicals and the airlines and the cruise lines and the recovery play in essence. How do your funds, or you basically automatically smooth that over? It's sort of like a barbell. You always had both sides covered and you continue to, or do you actually make these kind of tactical asset allocation shifts in response to these short-term market conditions?
That's a great question. I will answer it in 2 pieces. The first one is about today we are facing all these risks and everything is difficult, but that has been yesterday, has been a month ago, every day we face a lot of things. Every day it's a lot of uncertainty, no matter when we are, 10 years ago, 5 years ago, 10 years and 1 day ago, yesterday. So every day there is something out there. And that's why the market in equities provides higher returns because you have to bear the uncertainty, and that uncertainty is what $1 tomorrow invest in the market is not worth $1 today. It's less. It's discounted. You pay less for $1 that you may get tomorrow, and so this is the expected returns that you get. You're buying things in the future at a discounted price today, and that's to bear with uncertainty. Now, if I could predict what will happen tomorrow, if I could tell you interest rates are going for tomorrow up for sure, or if I tell you oil prices are going down tomorrow, or any other prediction that I have, I will do tactical asset allocation because it will be like printing money. I know that Apple is going up tomorrow. Well, let's buy it today, sell it tomorrow. Great, I'm printing money. It will be so easy if I could predict the future. Something, no one can predict the future. It's so horrible that we cannot predict the future.
Why do people love these people that make predictions and they believe them?
Well, people believe in different things in life. Some people believe that they can predict the future. We have biases to remember what we do well and to forget what we do bad. And that's why we survive in life. Imagine that you only remember everything that you do bad and nothing of what you do well. It would be horrible. Your memories would be horrible. So we tend to remember the things that we do well. So we bias ourselves to say, oh, yes, I'm super powerful. I can predict the future and whatnot. But in reality, we can't. No one can predict the future. And if you get it right once, it's a flip of a coin. Half of the time you get it right, half of the time you get it wrong. So that's why doing tactical asset allocation, in our opinion, makes no sense. It's much better to have a portfolio that is well designed, with low fees, with low turnover, focuses on the long-term goal. And it has to be diversified enough so we know that the daily volatility will not attempt against the portfolio. And that's what we do. We have portfolios that are low turnover, well diversified, always focuses on the long-term goal with enough diversification, knowing that the daily volatility doesn't affect the portfolio diversification or risk profile. And we know that it's going to go up and down, but always focus on the long-term expected returns.
But you're still always tilted towards small cap and value, correct? Like
that's absolutely
you have a
right.
company.
Yeah, that's absolutely right. And this is part of the research science that Phil was saying. If you look theoretically, let's think in theory. If you can buy two companies, and one company has a very, very high price relative to the cash flows or the equity in the company, and the other one has low price relative to the cash flows that the company generates, which one do you think that is going to be higher returns? The one that you overpay or the one that you're buying at a discount? Well, the one that you're buying at a discount probably will have better long-term returns than the one that you're paying too much. Yeah, it's basically all the science comes to that. It's more complicated, but that's a simple way to describe it. If you pay less for something, you should get more returns than if you pay too much for something. So paying less means buying companies that are value companies. That's a value company. Company you have low price relative to fundamentals. And the fundamentals is not just the equity in the company, it's the cash flows, it's combination of fundamentals so you can see the company holistically. So all our portfolios have a bias towards companies that have low price relative to fundamentals. So they are value tilted or small cap tilted. Yeah. And why is that? Because that goes towards the long-term goal. Because those companies then have long-term higher expected returns.
And let's talk about the asset allocation a little bit. Now, for your average equity investor, how far can you tilt the portfolio before they become uncomfortable? Right? I mean,
that depends on the person. I know people that only buy small value. I'm sure
100% small value investor.
Yeah, but they have fixed income also. Let me be clear. Not only equity, but people that have only small value. And why? Because they say, look, this is a long-term play, and I put the money here. Some people do that for their kids' portfolio. For the kids' portfolio, not for their portfolio, for the kids' portfolio, they only put a small value. I say, why? My kids are 7 years old. By the time they see the money, the market will go up and down. They don't even check on the portfolio. So why not to go for the highest expected return possible? And they do that. Some other people, they said, no, look, I cannot do that. I have to be more diversified and more sensitive to the whole economy, not just a small value. And they buy portfolios that are more market-wide, that have exposure to all the different asset classes, but overweight the ones that have high expected returns. So you have a little bit of everything, and as long as they know what they're doing and they're doing for the good reasons, that is fine. If they're doing for the wrong reasons, that's kind of a problem, because then they're going to be disappointed. And you don't want anyone to be disappointed. You really want people to go there and know what they are doing and do it with their eyes wide open and knowing the benefits that they expect to get, but also the risks that they may face. And that's very, very important. Phil, you may want.
I think the one thing I would probably add in addition, so I actually think it's okay for somebody to be disappointed in their returns. I don't think it's okay for somebody to be surprised. And I think that when you get into that allocation of just the market or some combination of market and small value or just small value, as Eduardo's saying, if you have somebody that says, I know exactly why I'm putting it in small value, I know the horizon, I know the goal, I know the volatility, and I'm happy with that, then their expectations are managed, right? But if somebody was expecting something that is a large growth portfolio or is a market portfolio, and they're in 100% small value, then small values returns will look very different than the market, right? So the S&P 500 could be up 10% and small value could be up 20, or small value could be up 0, right? That's the difference. It's going to have tracking differences relative to the market. And if they don't know why they're there or what the expectations are, then they're a lot more likely to abandon it in the bad times. And that's where we think you run into a lot of issues, right? We saw this actually last year. You saw a lot of money throughout the crisis go into money market funds. And it stayed there. It's still there. We can see it. So the markets went down. People were fearful. They pulled it out. They put it into cash, safe assets, and then it's just sat on the sidelines as we've seen markets recover and then really reach new highs, right? So that's what we're trying to avoid, and why we think that coaching aspect is so critical of the context around what am I hiring, this allocation to do? What's the role it play in my portfolio? And really understanding what can happen over short periods and longer periods.
And Mike and John, that's we have a slide on what just Phil mentioned, where we analyze when the money was leaving the market and going into money market funds. And man, it's so sad. It was happening at basically the wrong time. Humongous amount of money left the market a year ago, from February till the end of March, when the market was at the very low, and that money was out of the market when the market recovered, and those people suffer those losses. We'll send the slide. It's a lesson to be disciplined.
I think it's yeah. So go ahead, John.
No, I was just saying you're talking about opportunity loss, not losses. Yeah.
Yeah. Well, they suffer the losses. They suffer the losses. They sold, and then they couldn't get they come back on the market. And it's important to be disciplined, and it's important to have the right asset allocation.
I think it's very important when you spoke about managing people's expectations. When I talk to clients and we're talking about equities, I often tell them if you don't have a 10 or 15-year time horizon, you should think very carefully about investing in equities, because the probability of having a positive return, it's not even guaranteed after 10 years.
That's a true statement. The equities, equities have positive expected returns in our opinion. And so if you think about equities, let's say, I'm going to use a round number. I'm not saying that this is the right one. Let's suppose that equity have a 10% expected return. You don't get that 10% every year. There is no way you get it. It's because some years you get 20, some years you get 0, some years you get 30, some years you get -10. And inside that year, there is humongous volatility, ups and downs. And so, but the longer term, the longer that you wait, the mean becomes more and more important relative to the volatility. So you have a good point.
Mike had raised the question of asset allocation, and right now in Canada, and I'm sure in the States, these asset allocation ETFs from Vanguard and iShares and other companies seem to be quite popular. I don't know whether you have the equivalent. Is there an Avantis asset allocation ETF? And if not, it seems like you're primarily focused on stocks and secondarily on bonds as ballast. But do you touch on other things like gold, real estate, cryptocurrencies? How do you do those things?
Okay, let's speak. This is a package of questions, so I'm going to unpackage them a little bit, and please feel free to jump in. So if you think about asset allocation funds, funds that mix equity and fixed income, we don't have them. Why? Because those are great if you're going to sell to a retail investor, but that's not our goal. Our goal is to provide tools to advisors so that they can package the right asset allocation for that particular client. The advisor speaks to the client, try to understand the client's goals, try to understand the client's cash flows, the cash needs today versus the cash needs tomorrow, try to understand the advisor, try to understand the risk tolerance of the client. And then they put an asset allocation that fits that client. And so if we create an allocation that is 60-40 and with this mix, we don't know the client. You know the client. How can we put an allocation like that? So we are not focused on retail clients. We are focused on professional investors like advisors that help clients. So for us, an asset allocation fund really doesn't make a lot of sense. Maybe at some point we try to help 401k plans, but it doesn't really make a lot of sense for us right now. So we are focused, absolutely focused on trying to help advisors, and the toolkit is better than the package because the advisor has the flexibility to create what's best for their client. Now, we focus primarily in bonds and stocks. Yeah, so we have great fixed income and great equities to help advisors. What about all the other things that may be out there, cryptocurrencies and whatnot? Cryptocurrencies, I tell you two words, and then I will point you to a webinar that we have last week that you can see it in our website with Professor Andrew Caroli from Cornell. And basically, what is a cryptocurrency? Cryptocurrency is a means to effect a payment. So I need to pay you, John, for the bottle of wine that you sent me. You happen to be in Canada, I happen to be in the US, sending Canadian dollars for me is just a pain, and you receiving US dollars is also a pain. And so I send you a crypto dollar or whatever it's called, Bitcoin, yeah? You get in your currency, so it's a means to effect payments. It's basically like a fancy credit card at the end of the day. Now, do you expect returns from holding dollars or holding Canadian dollar? No, it's a means of payment. So the fact that this is fluctuating like crazy has to do more with liquidity of these currencies. And so why we're going to try to invest an allocation of our portfolio in something like that, it makes no sense. And so, well, some people get excited because the price goes down, but these things go up, down. You don't have a expected return for these things. So unless you can predict the future, knowing that tomorrow, for whatever random reason, is going to go up, and we can go into details why that may happen, it doesn't fit an asset allocation.
Do you think people perhaps are drawn to cryptocurrencies because they're concerned about fiat money, fiat currencies?
Well, everything. It's because of a lot of things. It can be because they're concerned of fiat currency. It may be because suddenly the price spikes like crazy, and some people, believe it or not, chase performance. And so, it's good to chase performance before the good performance happens. So not chase, go in advance. But we cannot predict the future again. So, and so we only deal with expectations, and they don't have high expected returns. It's just a currency, and so different people do for different reasons, and I cannot find a good reason. Now, look, we are going to speak for 1 hour on this, and I really recommend look at our website. We have a video there with Andrew Carroll explaining all this, and we have a write-up. And if not, we're doing another interview, but we are going to spend 1 hour speaking about this and why the price spikes and whatnot, and who is the natural holder of these things, because there is always a natural holder for this kind of instruments. And long-term investors based in Canada and the US, probably they're not the natural holders unless if they have some very weird issue that they're not worth getting into right now.
Okay, thanks, Eduardo. I'll definitely put a link to that video in the description of this one. Phil, do you have any thoughts on that?
The way that I think about it, if you think about the total market, right? So all the equities, all the bonds, trillions and trillions of dollars, right, that are there, that's the majority of the market, the investable assets, right? And so when I think about building a portfolio, what's part of the market is probably a reasonable place to start, right? And I also think about kind of the fundamentals of, if I'm investing in something, why am I investing in something? To Eduardo's point, like, what am I expecting to get back of it? The fundamental driver of an asset is that there's a value and there's some cash flow expectation associated with it, right? If I'm investing in a bond, I'm going to get a coupon payment. If I'm investing in a stock, there's capital appreciation potential. I might be getting a dividend depending on the company, right? That's the idea of investment. We're exchanging some capital for the hope that we're going to get more in return. And we're going to have another piece coming out from Professor Mir Statman on Bitcoin and how he talks about it more. Mir's just fantastic, I think, in framing things more from, maybe I'm not going to just completely say a behavioral sort of way, but in a way that I think is very accessible for the end investor. And he talks about it. Listen, if somebody wants to dabble in something like that, then it might be fun and everything else, but it shouldn't be a core part of a portfolio. And that I think is quite a reasonable view.
When I'm talking to investors and they ask me about hedge funds or alternative investments, generally I tell them, you can have a very successful investment experience with just simply bonds, equities, and cash. I mean, there's no real need to go into all of these things.
I think that's very simple.
I completely agree. Yeah. Why are you going to pay someone a fortune to predict the future if you don't think that they're going to predict the future? So I agree with you.
Let's focus back on stocks then. It's obviously your favorite asset class, and everybody here probably. Do you have any expectations of returns? I mean, are people's expectations too high right now, too low? I mean, you see a lot of this, and people seem to think that the next 10 years won't be as good as the last 10 years and all that kind of thing.
They may be right, they may be wrong. We don't. That's the beauty. We don't know. Probably the best way to estimate returns of stocks is look for long-term averages. There are other things that you can do by looking at valuation ratios and whatnot, but the noise is so high that really doesn't give you a lot of information. And when you're investing, like Mike was saying, in stocks, you're not investing for the next 3 years or 5 years. You're just investing for the next 15, 20 years. You're really, it's a long-term investing process. And so the best you can do, probably do long-term average. What have been the returns of the stocks for the last, since we have data? And that number gives you, a good feel. It can be off a little bit higher, a little bit lower, but it gives you a good number to think about that. So if you go back in time, and I'm speaking about U.S. markets, not Canadian markets. I'm sorry about that, but I have more data about U.S. markets. So if you go back to all the history that we have is to the 20s. An average return of 10% for the U.S. market is in the ballpark. And so when you do your long-term planning, knowing 10% average return, maybe you discount it a little bit just to be more safe. And that's a good number. Is that number going to happen every year? No. We have years that are amazing and years that are horrible. But that's a good average. Look, if you go back to 1920s, you have the big crash of 1930s. Then you have the Second World War. Then you have so many events that were horrible, but then others that were good. So it's it's a good path in history with a lot of things going on to compute an average return and have an estimation of what may be the future.
Now, the recent SPIVA reports showed that large cap active managers have underperformed the S&P 500 for 17 out of the past 20 years. Now, we've got similar results for small cap, mid cap managers, not just in the US, but internationally as well. And as these indexed assets have grown, the savings to investors on just S&P 500 linked products alone is estimated to be about $300 billion from 1996 to 2019. Could you speak a little bit more about how important fees and expenses are and why investors should pay attention to them?
Well, if you buy 10 stocks, those 10 stocks are going to give you a return. But if you buy those 10 stocks inside an ETF or a mutual fund, the 10 stocks are going to give you the return minus whatever you pay in fees and expenses. So whatever you pay in fees and expenses is going to subtract from the returns of the stocks or the bonds that are inside the fund. The higher the fees and expenses, the less money for you. The lower, the more money for you. And so you want to pay as little as possible, but still have a good portfolio. So paying zero for something bad is really not a good idea. It's better to pay 20 basis points or 10 basis points for something that is good than zero for something that is bad. But paying 20 basis points or 10 basis points for something that is good is better than paying 2 and 20 or 2% or 1% or 0.5% for something that is as good. So, a lot of people charge a lot because they promise that they can predict things. If you don't think that they can predict those things, you shouldn't pay so much. You should get a good portfolio at a low fee. But you mentioned something that is important. Index funds have saved a lot of money to investors. I completely agree with that. But the bigger and the bigger that the index funds become, the more issues they have. And why is that? A very simple thing. Some of these index funds are so big that when they have to change a name, they are selling a lot of shares of the company that they're selling, and they're buying a lot of shares of the company that they're buying. And you can go to a supermarket to buy oranges, and you can buy 10 oranges, and that's great. But if you want to buy 50 million oranges from the supermarket, you cannot find it. And so what happens? Well, the supermarket will call all the other supermarkets and will call all the suppliers. And what's going to happen with the price of oranges? Well, it's going to go up. And so you finish paying too much when you try to buy more than what is available. And so that's a little bit of the issue that index funds are having with their popularity. They are great solutions, but at some point they probably become a little bit too big to deal with the liquidity requirements and other issues around that they have. So what we do is something that has the same benefits of an index funds: low turnover, diversification, low fees, but try not to behave like an index funds, just having to trade like crazy on particular days because a name has to be dropped or added. Because at the end of the day, adding it or deleting that name today or tomorrow or the day after, it's all more or less the same. So why not to focus how much we pay for those transactions instead of trying to get them done impatiently right here, right now, no matter what. So there's a little bit of nuance, but it's important.
It sounds like you're talking there about something like the ARC funds and Cathie Woods, who's pretty ubiquitous right now. I mean, they did spectacularly, 100% plus last year in the pandemic, and they have sort of had a sell-off during this tech route of the last couple of months. But as far as I know, that's not a passively managed ETFs. Those are actively managed by Cathie Woods and her team. Is that what you're referring to, or were you talking about passively managed broad beta indexes?
Well, we don't have index funds. So our ETF are called, or mutual funds, but our ETF are called transparent active. So if you have an ETF, they can be index ETF, They can be active ETFs that call semi-transparent active, or they can be fully transparent ETF. We are fully transparent ETFs that are active. So what does it mean that is active? What it means is that we're not tracking an index. We are not forced to buy and sell security on any particular day. And why? Because we don't want to have the flows of an index that today you have to buy yes or yes because that's what the index says. But today there is no liquidity. How can we trade today? Doesn't matter. Do it. So we're trying to avoid that. And so, you go to the supermarket to buy oranges. There are no oranges. It doesn't matter. I want the oranges today, right here, right now. There are no oranges, but I want them now. So we're trying to avoid those situations when we manage money. And so that's why we are active. We're not tracking an index. But from the point of view of diversification, from the point of view of low turnover, from the point of view of having a consistent and transparent investment approach, we are very, very similar to indexes, not to an active manager. That's why we're fully transparent. Every day we tell you what we call like an index does. And it's basically all the benefits from the index without the drawbacks.
Now, this question is both for Phil and Eduardo. I'm interested in learning a little bit about your relationship with Fama and French. What would you say would be the most important insights you learned at DFA, and how are you applying those at Avantis?
I can go. Look, Ken and Jean are magnificent people. I cannot overstate how great they are, and they're truly scientists. Both of them have changed finance, have changed how we think about so many things. Starting with efficient marketing processes, but it's way beyond that. It's their contributions to science and their contributions to all different aspects of investments and beyond investments. It cannot be understated. They are not only as people, they are great people, but as people that have contributed to humanity to have a better life, probably are among the top ones that you can ever find, because they have helped us have a better life by investing in a better way. And investing and saving is a big part of life, because that's how we find our later years in life. So what can I tell you of them? Man, all of us have to take the hat and just say thank you for everything they have done for humanity. But in some of our cases, like me personally, I worked with them for a long time. Personally, for me, they have done a lot. A lot of what I know is because of just interacting with them. By being close, osmosis, just you learn a little bit of the humongous amount of knowledge that they have. So I cannot speak better of both of them. They're amazing people.
I think I heard you say one time working with Fama and French was like doing another Ph.D.
Every day. It's absolutely, but that's a beauty. You always want to speak with people that are amazing, because they add to your knowledge and you become better. At the end of the day, we are passing through this life, and every day we want to become a little bit better by learning something new. And those are people that really contribute in making everyone better.
Phil, how about you? What can you say about Fama and French?
I completely agree. I think there's a measurement. I think it was in a book that actually the introduction was from Gene's colleagues to him. It was kind of a letter just celebrating him and the impact that he's had. And they had, I forget the exact measurement, but they basically looked at the citations that are the number of citations for his papers, right, on SSRN, where a lot of papers are published and referenced, and using that as sort of a proxy for how much his work, and Ken's the same way, has accelerated the work of others, right? Because that's how science evolves. In order to be able to test something or improve it, you need something to test it against. And their models have been tested. They've really become sort of the standard of what everybody tests their theories against. And that to me is just, it's such an incredible contribution. But beyond that, they're just quite thoughtful individuals, right? They're philanthropic. They're good people. They're generous with their time. Gene is quite careful with how he spends his time. I remember I had the opportunity to interview him a couple of years ago, and we were talking about sort of prepping, and he's like, "We're just going to do this on the fly." He's like, "It'll be fine." And I'm, nervous because I have to interview Gene Fama, right? But he is somebody where if you talk to anybody that's worked with him and how he referees papers, everything else, he's always one of the fastest ones in terms of turning papers back around, because he thinks that if it's worth doing, if you're going to say yes to it, you do it right now. And so I think it's not only kind of the attitude and the contributions that they've made, but it's the commitment to science that's so great.
Well,
there,
Phil,
there are other papers, you speak about the three-factor model, but there are other papers that are magnificent. Like the taste and preference paper is magnificent. But there are so many papers that they have that are magnificent, and things that they have not published that are also magnificent. So they're great people.
Now, you talked about investing with a purpose. So both, I'd like to hear from Phil and Eduardo. Talk about the relationship with American Century and Avantis and the Stowers Institute. This is kind of a unique story. It's not something you see every day, or it's not something you see anywhere, really.
Yeah, absolutely. It's something that we're quite proud of. I know it was an attractive trait for me in terms of coming over and joining one of the many. But so Jim Stowers, who is the founder of American Century Investments, both he and his wife Virginia were actually cancer survivors, and so that was something that they both obviously had a very personal connection there. But what they wanted to do was contribute to the research. So now we're talking more about science, right? This idea that we can try to have an impact on gene-based diseases. And so what they did was they took their ownership in American Century and they used it to create or establish the Stowers Institute for Medical Research. And so since 2000, there's actually been more than, I think, $1.7 billion by way of profits of American Century. So a portion of the dividends are going to fund the Institute each year. So more than $1.7 billion has been directed that way over the last 20 or so years. And so it's a phenomenal operation. Unfortunately, with COVID and everything, I haven't had the personal opportunity to tour it. I think Eduardo has, but more than 500 people working there. We've gotten the opportunity actually a couple times throughout this crisis to hear from experts at Stowers on COVID, vaccines, and everything else, and just that experience alone, the amount of knowledge and things that there and the contributions that are being made are something that we're just so proud of and so happy to be a part of.
Am I correct? Am I correct in understanding that Stowers actually has majority ownership of American Century?
It's a controlling shareholder of American Century. So it's a beautiful structure, because if you think about that, we are a private company that is magnificent because you can have long-term planning, but it's the controlling shareholder. It's established a perpetuity. It's not a lifespan or anyone. And so it's magnificent. So not only we feel good about the corporate structure that is private at perpetuity, we also feel great because the controlling shareholder is doing something great for humanity, trying to solve health issues for humanity as a fundamental science research. It's just magnificent.
Well, I heard the saying, one of the best ways not to get sick is not to be poor. So, I mean, if we're talking about investing, you're talking about financial security, and it's all related. It's tied into health.
Yeah, well, the Stowers Institute, that's things for everyone, no matter your wealth, because when you do fundamental research on how to solve cancer or other genetic diseases, you are really helping everyone, and and we are very proud of that association. Very, very proud.
John, do you have something?
I think our readers' attentions will start to attenuate from about now on.
All right. Well, I very much appreciate. If you have any parting thoughts, what you think the most important thing for investors to focus on, just give us a parting message, and I'd very much appreciate it.
Phil?
I would say that, so when it comes to investing, the most important thing is to start with a goal. I was actually speaking with somebody very close to me a couple of weeks ago, and they said, "I'm going to have some cash coming up. Where do you think I should put it?" And my first question back was, "Well, what do you want to do with it?" And it's really important to have that context. I think you each spoke about it, right? And so that's something that if you know what the goal is, then you start to understand what risk is relative to that goal. You start to understand what a good hedging asset might be, what propensity for risk you might be able to take off of that hedging asset. And that framework is just so critical, going back to sort of that setting and managing expectations. If you start there, you're a lot more likely to have a good experience. So that would be what I would say.
And I think what Phil said is magnificent. But one more thing is, if you don't know how to do these things, ask for help. And try to ask for help for an investment professional, an advisor that really knows how to do these things and know how to put it in the context of taxes and everything else. And so do everything that Phil does, is saying, but also be cognizant that sometimes you need help.
Gentlemen, thank you very much. I very much appreciate it, and hopefully we can do it again sometime.
Whenever you want, you know where to find us.
Thank you.
See you. Bye, guys.
Thanks very much.